Borrow Smart segment today being brought to you by, I don't know, rsrhomeselect.com. rsrhomeselect.com. Why am I passionate about the reversed mortgage? Simple. My mom and dad. Well, that 15 years ago, maybe more, my mom and dad got into a reverse. We helped them get into a reverse mortgage. Great tool. They lived with it for many, many years. And when my dad passed, my mom didn't have to make any mortgage payments. Mom passed. I was a successor trustee or co-successor trustee. So I understand the program. I understand what it's all about. I understand how to liquidate it, how to live with it, how to enjoy it, the benefits. I also understand the myths. And these are big because so many people have a misconception about the reverse mortgage. Myth number one, the lender owns the home. No, they do not. You own your own home. Doesn't change. It's a lien, just like any other lien on any other piece of property. This is just a lien. Myth number two, the borrower is restricted on how to use the loan proceeds. No. Use them for whatever you want to use them for. Myth number three, it's only for poor people. No, again. I find a lot of people are using it for strategic planning. So yes, it can help seniors that are having some financial challenges. Not saying that doesn't do it, but there are others that, they're in totally good shape, but they have other desires. We helped my friend, the late Jay Kaplan, helped somebody. $25 million home, free and clear, didn't owe anything on it. He got a $4 million reverse. It was not the FHA reverse. It was a jumbo product, but he got a $4 million reverse and was able to give each of his sons $2 million toward the purchase of a new home. They were going to get the money anyway. Didn't change his lifestyle, the father's lifestyle in any way, but he got to watch his sons and their families enjoy the new homes. They were going to get it. So now he gets to have some enjoyment. These are just things that happen. Had another one. A lady has a $10 million home, give or take, and was able to do a $4 million reverse. Gave each of her kids $1 million, or each of her kids $1 million and put $1 million in the bank. Think about those concepts. Now, those were not needs. Those were wants. Wanting to see that happen. So it's not only for poor people. Number four, once loan proceeds are received, you pay taxes on them. Taxes are called income taxes. This is a loan. There are not taxes on the loan. Again, I don't give tax advice. You've got to go to your tax professional for that. But these are loan proceeds, not taxable. Number five, the home must be free and clear of any existing mortgages. No. If you've got the equity in the property, you pay off the existing lien and you get the reverse mortgage. Go on your merry way. If you have extra money there, fine. So it does not have to be free and clear. And as I mentioned in the last segment, you can even use the reverse mortgage to buy a new house. So what is a home equity conversion mortgage? That's the fancy name. That's the FHA name for a reverse mortgage. Because the reverse mortgage years ago had that bad connotation that they were going to take your home. That was in 1985 that stopped. So a home equity conversion mortgage, a loan allowing 62-year-olds or older in age to stay where you are, basically, or buy a new house. It gets access to equity. The borrower receives the proceeds in a lump sum, line of credit, monthly payments, or a combination. It's FHA insured. It is a non-recourse loan. What does that mean? Your estate will never owe more than what is owed. So they don't have to come out of pocket once you pass or leave the property. It's non-recourse. Repayment is deferred. No monthly payments are required, but you can. And sometimes there are tax advantages to doing it that way. Yes, you can buy a home with a reverse mortgage. So if you're selling a property or you get a large lump sum of money somewhere, whatever, and you go and make a down payment, generally you're going to be in the 40 to 50% range depending upon your age. So yes, you can use it for a purchase. Again, the amount you get is based on your age and the interest rate. So as interest rates are higher, the amount you get is lower because of the way that works. Home equity can be a flexible way to solve many retirement challenges. Create additional sources of non-taxable monthly income. Eliminate monthly mortgage payments to boost cash flow. Provide alternative to drawing down retirement savings and qualified plans. Purchase a new home. It gives you flexibility. You may be able to wait. When the markets are good, that's when you want to take money out of the market. When the markets are bad, no, you don't want to take money out of the market when it's bad. You can use money from other sources. This might be that other source. What happens when the loan ends? 3 options when the loan becomes due and payable. That means the last borrower sells or permanently moves out of the house, passes away, or fails to meet the terms of the loan. What are the terms of the loan? We got to pay your taxes. You got to keep insurance, and you must maintain it in a safe manner. So all of those are the terms of the loan. 3 options: repay the loan and keep the house. You might do a refinance, whatever. Might be insurance proceeds or maybe other proceeds that your heirs or your trust. Oh no, by the way, yes, you must have a trust. It's not a requirement, but you should. I digress. Sell the house, repay the loan, and keep the remaining equity. So you've got a house that's worth $800,000. You've got a loan that's worth $400,000 or due. Sell it, and the difference, $400,000 less expenses, is what goes into the estate or to the person leaving the property. If it's the senior can sell the property anytime they want to. If they, for any reason, moving out of state, want a different property, like a different community, want to get closer to the kids, whatever it is. If the loan balance exceeds the home's value, you deed the home to the lender. No repayment beyond the home's value is required. Although, if the heirs want to keep it, they can keep it. They just pay 95% of the appraised value to settle the loan. Pretty simple. Reverse mortgage has evolved over time. It's no longer the last resort. It's not merely for people with financial distress. More financial planners are recommending as a retirement strategy. If you're a financial planner, you should be talking to your clients about this because it might give you an opportunity to help them, as I mentioned earlier, with increasing their lifestyle, because they're taking some of the equity as they sell their property or move to another property or take a reverse mortgage. They're not having to pull cash out to make a mortgage payment, or maybe they're taking cash out and they're putting it into CDs or treasuries or things like that so they can take money over time and enjoy their golden years. Once you get to that age, my personal opinion, it's all about cash flow. It's all about cash flow. You're not building wealth anymore at this stage of life. You're about cash flow. How much cash flow do you have? What do you need? How do you enjoy the golden years? Options and flexibility have made a reverse a powerful financial product. I love the reverse mortgage. So we keep on, whoops, where it is. Who is good for a reverse mortgage? It's if you're over 62 years of age. There are some that go younger, but for the most part, over 62 years, 50% or greater equity in the home and resides in the property. It is not a loan for investment properties or second homes. You got to be in the property. It's got to be your primary residence. How do you qualify as a primary residence? Technically, you're there 183 days a year. That's the basis, over half the time. Smart reverse strategies. Eliminate monthly payments by refinancing out of a standard mortgage. That's what my parents did. They had a mortgage. We had pulled money out of it over and over again strategically. They had that invested strategically. They did not need the cash. But in the golden years, why did they need, I think it was a $3,400 mortgage payment? They didn't. So we changed out of it. Increased liquid cash flow. Well, They didn't have to pull that $3,400 out of their savings or the retirement funds on a regular basis. Love that idea. Bridge the Medicare gap from age 62 to 65. Well, now you've got some extra funds to be able to pay for insurance if you were retired. I like this one. Well, it didn't happen for me, but inheritance advance. I told you those two stories earlier about the folks, one with a $25 million property, one with a $10 million property. Their kids were going to get the money anyway. It just advanced it. So the senior got to see them enjoy it, got to enjoy the gift of giving instead of them getting it after, they passed. How about the 401k and the IRA extension? You get to strategically take the money. You're not taking the money when you have to. You're taking the money when you want to, when it's strategic for you. What's the process like? Well, it all starts with a consultation with a counselor consulting with the borrower. Actually, we talk to you first, then you go to a counselor and application complete. What does that mean? Well, you're going to have to go and have counseling. Generally, right now, it's done online. So there's counselors all over. We give you a list of about 10 different counselors to use. Then on the back end, the team will pull a case number and order for the appraisal and whatever services or needs. Files submitted to underwriting just like any other. Conditions are issued, clear to close, and you get the money. But requirements: live in the home permanently, stay current on property taxes and assessments and insurance, keep the homeowner's insurance policy in place, and maintain the home. It's got to be safe. We're not looking for anything like that. Remember, the homeowner keeps full title, ownership, and control of the home. That never changes. Qualifications: all borrowers must be at least 62 years of age, must have sufficient equity, pass the financial assessment. Not too hard. If you don't pass the assessment, then you might have to go with a set aside for taxes and insurance. Must be the primary residence, no second homes or vacation homes. All borrowers must attend the counseling. We talked about that. 4 nevers. The homeowner and his estate never give up title to the home. Number 2, the homeowner, when leaving the house or his estate, can never owe more than the home's values. Conversely, when the home is sold, sale proceeds in excess of the debt amount belong to the borrower's estate. Number 3, even if all the money that can be borrowed through the reverse mortgage has reached its limit, the borrower never has to move, provided the taxes, insurance, and home maintenance are continued. Number 4, monthly repayments are never required or expected, although voluntary payments are accepted. So you can do that. Eligible property types: single-family residence, modular homes, 2 to 4 family residence where the borrowers occupy one of the units, townhomes, planned unit developments, PUDs, condominiums, if they're approved, site condominium. All of those things are good to go with it. Got to make sure your state and local taxes are current, or they have to be made current. We look at that also. Talked about the living in the property. There are some alternatives. If the home equity conversion mortgage, the FHA product, isn't the right one for you, there are seconds that are available. There are jumbos that are available that'll go up to a higher loan limit. And as we've talked about many, many times, the Home Select loan may be the right one for you as well. So we look at all of those options to find out what is the suitable product for you. That's the Borrow Smart segment, talking about reverse mortgages, brought to you by rsrhomeselect.com, rsrhomeselect.com. Also, want more information? Ask about reversemortgages.com. Ask about reversemortgages.com.